To truly build wealth, it's important to shift your mindset from being a consumer who works for money to an investor who makes money work for you. In today's video, we are going to talk about 5 assets you can buy to make your money work for you. By focusing on acquiring assets that generate income and appreciate over time, you can create financial stability and freedom. The key is to have a long-term investment strategy, conduct thorough research, and stay disciplined even during market fluctuations. Remember, building wealth is a journey that requires patience, knowledge, and the willingness to adapt to changing circumstances. The first asset we can choose is real estate. This is a class of asset that can help you build wealth. Investing in properties can provide both short-term cash flow through rental income and long-term appreciation in value. Real estate can be a stable and lucrative investment option if approached strategically and with due diligence. When you invest in real estate, you purchase physical property, such as a single-family home, condo, apartment complex, office building, retail building, or mixed-use building. This investment requires more capital and effort on your part, but it allows you to own something tangible. The main purpose of buying real estate is to generate cash flow. There are various goals people have when investing in real estate. For some people, the primary goal is cash flow. They don't have to focus on speculating about future property values. Their analysis is based on how much cash flow the property can generate annually. They calculate the expected profits by considering the property's rental income, expenses, and potential profit margin. If the projected cash flow is sufficient, they consider buying the property. Maintaining a healthy cash flow is crucial, especially during economic downturns. By having a comfortable margin, you can lower rents without losing money, even in challenging economic conditions. Overleveraging is a common mistake in real estate, where individuals pay too much for a property, resulting in high expenses. This excessive debt leads to larger mortgage payments, higher property taxes, and more expensive insurance premiums. If unexpected events occur, such as lower rents or vacancies, overleveraged investments can quickly become unsustainable. To effectively manage real estate investments, it is essential to have a capable property management team. While you don't have to directly manage your properties, you hire a property management company responsible for finding tenants, screening them, collecting rents, handling property maintenance and repairs, and ensuring the properties remain in good condition. A reliable property manager significantly simplifies the investment process, but a poor one can become a source of stress. Entering the real estate market can be challenging, as it involves finding the right professionals to work with, including real estate agents, property managers, contractors, real estate attorneys, accountants, and property inspectors. You also need to learn about dealing with city inspectors and navigate the learning curve. It can be a time-consuming and costly process, especially for the first few deals. However, once you overcome these initial hurdles and build a solid team, investing in real estate becomes more straightforward and streamlined. You can also generate income and legally reduce your tax liability, but you can also pursue property flipping as an investment strategy. When we mention flipping properties, we don't mean literally flipping them like in a physical sense. Instead, it involves purchasing a property and holding onto it for at least a year before selling it for a profit. The key advantage of this strategy is the ability to defer taxes on the profit earned. Let's say you buy a property today for $300,000 and hold onto it for 4 years. Suppose you made a wise investment, and the property's value has appreciated significantly during that time, allowing you to sell it for $1 million. This would result in a substantial profit of $700,000, which would typically be subject to significant tax liability. However, real estate offers a unique benefit known as a 1031 exchange. A 1031 exchange enables you to take the entire $1 million from the sale and use it to purchase a larger property with more cash flow and potential profit, all while legally deferring any tax payments. It is distinct from other investment options, such as stocks, where you would still be required to pay taxes on the profit if you were to reinvest the funds. If you are willing to go through the necessary steps and learn from your mistakes, success in real estate investing is attainable. It's about analyzing market trends, identifying undervalued properties, and understanding the potential for rental income and property appreciation. It's about managing your properties efficiently, ensuring high occupancy rates, and maximizing your returns through rental income. The second asset we can consider is the stock market. The stock market is another class of asset that has continued to grow and provides opportunities for investors to make money. But it's important to have a long-term strategy and not just chase after the latest trends or hot stocks. Investing in the stock market requires research, analysis, and patience. It's about identifying companies with strong fundamentals, sustainable growth potential, and a solid track record. It's about diversifying your portfolio and spreading your risk across different sectors and asset classes. In stock, you stand to make a significant profit. But if the company faces challenges or fails, you can also lose a substantial amount of money. The key is to understand your risk tolerance and investment goals. Instead of focusing solely on individual stocks, you can also consider investing in exchange-traded funds, ETFs, mutual funds, or index funds. These investment vehicles provide diversification by investing in a basket of stocks or other assets. For example, an ETF may track a specific index like the S&P 500, while a mutual fund may aim to achieve a specific investment objective. These funds are managed by professionals who carefully select and manage the underlying investments, reducing the risk associated with individual stocks. The next consideration is whether to invest in cash flow producing stocks or non-cash flow producing stocks. Cash flow producing stocks, also known as dividend stocks, pay regular dividends to shareholders. These cash payments can provide a consistent income stream, especially for investors seeking passive income. On the other hand, non-cash flow producing stocks focus more on capital appreciation. These stocks may not pay dividends but instead aim to increase in value over time. Depending on your investment objectives, you may choose to invest in one or a combination of both types of stocks. Finally, your stock market investing strategy can be passive or active. A passive strategy involves investing in index funds or ETFs and holding them for the long term. This approach seeks to match the performance of the overall market rather than trying to outperform it actively. On the other hand, an active strategy involves actively managing your investments, buying and selling stocks based on market trends, analysis, and personal judgment. This approach requires more time, effort, and expertise, as you are actively seeking to beat the market. There are various options for investing in the stock market, including individual stocks, ETFs, mutual funds, and index funds. It's crucial to assess your risk tolerance, investment goals, and the amount of time and effort you are willing to dedicate to stock market investing. Diversification, understanding cash flow versus capital appreciation, and choosing between a passive or active strategy are all factors to consider when building your investment portfolio. Remember, investing in the stock market involves risks, and it's essential to conduct thorough research and seek professional advice if needed. On the other hand, exchange-traded funds, ETFs, are similar to index funds in that they track a specific group of stocks or assets. However, ETFs can be bought and sold throughout the trading day, just like individual stocks. This provides more flexibility for investors who want to take advantage of market fluctuations or make quick investment decisions. ETFs also tend to have lower expense ratios compared to mutual funds, making them a cost-effective option for investors. Mutual funds, on the other hand, are actively managed funds. They are managed by professional fund managers who make investment decisions on behalf of the investors. These managers actively buy and sell securities within the fund based on their investment philosophy and strategies. Mutual funds offer a variety of investment options, such as growth funds, value funds, or sector-specific funds. However, it's important to note that mutual funds typically have higher expense ratios due to the active management and research involved. In summary, instead of investing solely in an individual company like Amazon, you can consider investing in funds such as index funds, ETFs, or mutual funds. Index funds provide exposure to a particular group of stocks and are passively managed with lower fees. ETFs offer the flexibility of buying and selling throughout the day, like individual stocks. Mutual funds, on the other hand, are actively managed and offer a range of investment strategies. By diversifying your investments through funds, you can reduce the risk associated with individual stock holdings and potentially benefit from broader market trends. Remember, it's crucial to conduct thorough research and consider your investment goals and risk tolerance before making any investment decisions. Bonds and fixed income instruments. Investing in bonds and fixed income instruments can be a more conservative approach to building wealth. Bonds are debt securities issued by governments, municipalities, or corporations to raise capital. They provide regular interest payments, coupon payments, and return the principal amount at maturity. Bonds offer stability, especially government bonds, as they are considered less risky than stocks. Investing in bonds requires understanding credit ratings, interest rate risk, and the economic outlook. It's about diversifying your portfolio and balancing the risk-reward trade-off. Business ownership. Owning a business can also be a powerful asset that generates wealth. There are two main approaches to achieve this: starting your own business or investing in someone else's business. When you invest in stocks or real estate, you aim for a consistent 7–10% return on your investment, which is a solid long-term gain, especially for a passive investor. However, when you invest in your own business, the sky is the limit to the potential returns you can achieve. Financially, the returns can be higher, but it also carries a greater level of risk. Additionally, owning and operating your own business allows you to nurture and expand it according to your vision. If you're not an entrepreneur or don't have a specific business idea to invest in, don't worry. You can still invest in other people's business ideas. Crowdfunding has made investing in startups more accessible, particularly in these times of the last pandemic. With new regulations in place, even regular individuals can invest in startups with small amounts of money, sometimes as little as $100 or $200. However, it's important to understand that investing in startups comes with risks. Statistics show that most startups, around 8 to 9 out of 10, fail or go bankrupt within the first 5 years. This means that most of the startups you invest in may not yield a positive return. Nonetheless, the aim is not to lose money with every investment. When a startup does succeed, its returns should hopefully outweigh the losses incurred from unsuccessful investments. So, investing in startups requires a different skill set, plenty of work, and a certain level of risk. Overall, whether you choose to start your own business or invest in someone else's, the reality of business investing provides unique opportunities that can potentially yield significant financial growth and independence. It's about identifying a market need, developing a solid business plan, and executing it with dedication and perseverance. Owning a business allows you to create multiple streams of income and build equity that can be sold or passed on to future generations. Alternative investments. Finally, exploring alternative investment options can potentially provide unique opportunities to grow your wealth. These can include commodities, precious metals, hedge funds, private equity, venture capital, cryptocurrency, and more. Alternative investments often have lower correlation with traditional asset classes and can provide diversification benefits. However, they also carry higher risks and may require specialized knowledge or expertise. It's essential to thoroughly research and understand the underlying assets and risks involved before investing in alternatives. This video does not offer any financial advice. Its purpose is solely to share research findings. If you have individual inquiries concerning your financial circumstances, it is recommended to talk with a licensed financial advisor in your region. Don't forget to hit the subscribe button and click the notification bell so you never miss out on our upcoming videos. Until next time, happy earning. Thank you for watching.